Hello and welcome to Income Tax Planning, topic 42. This is our first topic for financial planning. We are going to discuss the income tax fundamentals. For example, we're going to see who has primary and secondary authority. We are also going to start discussing accounting periods, cash and accrual. And note that cash is mostly for tax basis. And we're also going to go in more detail on in-accounting methods. So the primary source of authority is the Internal Revenue Code. That's our tax law. But then we also have Treasury regulations, and they have the force of law. We have revenue rulings and procedures, and they are relied on, but they are not the law. So make sure we understand that revenue rulings and procedures may be relied on, but they're not the law. We have private letter rulings. They're also relied on only by the taxpayer who requested it. And then we have court cases that are relied on if there is some type of fact pattern that parallels the case that we are covering. This is heavily tested on the CFP, Certified Financial Planner exam. So you should know the difference between primary and secondary sources. And you should also know which is law and which isn't. As we learned here, revenue rulings are not law. And then private letter rulings are only law to the taxpayer that requested it. So I would recommend that as you go through these topics, you start taking some notes that you can use to study. Because remember, income tax planning is only one section of the CFP exam. So that way, if you have a set of notes, whether electronically, which would be my recommendation, you can go ahead and just go back and refer to them. So now let's move to our secondary types of authority. And now these are more like a guide. So they're not really primary sources, they're a guide. They are not a substitute, but they kind of help us out. And then CCH is probably the most commercial publisher that I've used in the past and very heavily used in industry and in academia. So those are just some publishers that kind of make sense and give you like an English perspective on the tax law. So for accounting periods, right, taxes are usually computed and paid on an annual basis. And taxpayers generally have a calendar year because of the W-2 reporting. Remember, you fill out a W-4 with your exemptions, but the W-2 kind of gives you your gross wages and the taxable wages that you have. Now, fiscal years can be chosen, but you need IRS approval for that. This is very rare, so as you start your career in financial planning, you won't see that very often. But S corporations and partnerships, they must conform to calendar year or reporting year of the majority of the partners, unless there's a valid business reason that they should establish a fiscal year. In my experiences, I've usually kept, especially in partnerships and S corporations, the calendar year. It just is easier because once you file an 1120S, remember S corporations have an 1120S, and then a K1 is what passes through to the individual owners or the partners. So you want to make sure that they're all on the same page, and usually if you're all on the same calendar year, then it's easier to maintain. So we have certain types of accounting method, cash and accrual, and we have a hybrid. Cash income is taxable basically when it is received, and then there's no restrictions associated with the cash, and then expenses are deductible when paid. Most small businesses follow a cash basis, and then they run into trouble when they're trying to get loans because they just show this up and down spiral with cash. Hence why we have the accrual basis. And if you remember from accounting, accrual basis is GAAP. So we usually use cash basis for tax, accrual basis is GAAP, and here we're talking about you record revenues when they're earned and you record expenses when they are incurred. We adhere to the matching principle of GAAP. So this is what most publicly traded companies use, but then the smaller businesses use the cash basis. We have a hybrid method which combines both cash and accrual. And you can use this as long as the method is consistent and it reflects your income stream. So when you change from one to the other, and if you're going from cash to accrual or vice versa, you need IRS approval. I would say the most common in practice is usually cash basis for smaller businesses, accrual basis for the larger organizations. So you'll probably be exposed to both in your work as a financial planner. Now, NOLs are net operating losses, and this is critical. It can be carried back 2 years or carried forward 20. So you can go back 2 or you can go forward 20. Now, if the net operating loss is carried back, it can give us a tax refund. So that's why we do it sometimes. As you start preparing tax returns for clients, you will actually play with this a bit and see, is it beneficial for us to carry it back for the 2 years? Should we carry it forward for the 20? So you just want to do some financial planning, some tax planning when it comes to net operating losses or NOLs. And that concludes our topic 42, income tax planning. I hope you read through the chapter. So at this point, I would say read and take your notes. And as a study guide, this will help you as a study guide for the CFP exam. And then I would do all the multiple choice questions at the end of the chapter. And that should hopefully get you, or the topic, and that should hopefully get you pretty set for the test so far. Thank you.